Alright, so today we're taking a look at Washington Trust Bancorp. They're out of Rhode Island. They also have a presence in Massachusetts and Connecticut, so sort of in the Northeast New England area. But if we take a look at the Yahoo Finance page, we've got kind of ups and downs throughout the year. That's usually what we see for most banks. This year, it's a really small bank. It's about 438 million of market cap. It's got about a 9.5 PE ratio. That's maybe a little over 10% or so of an earnings yield. Really high dividend yield. So we could say maybe it's priced about average for its earnings, and really cheap for its dividend. But once we dig in a little more, we might find out why that might be the case. It's a pretty unusually high dividend yield. And we see the price to book's about 0.95. That's about average for most banks. Most banks are around 1 probably. Somewhere between 1 and 1.25 probably. So it's priced a little bit cheaper than a lot of banks. And so there might be a reason for that. It does look like maybe it's not as profitable as most banks. Return on assets 0.66%. Usually we look for somewhere at least 1% or so. Return on equity is a little bit lower as well. So yeah, we can already tell that it's priced a little bit cheaper than most banks, but maybe not as profitable. And once we dig into the financials, we'll be able to see a little bit more about how they're set up and what the risks are and such. So let's dive in. So we've got a normal bank balance sheet here. Some cash, some securities, some loans, some BOLI, and a little bit of goodwill. So pretty customary balance sheet here. That was on the asset side, deposits, and then some FHLB advances and the equity. But if we were to dig into individual components, we've got about $100 million of cash here. That's not a whole lot. It's about 1.5% of the balance sheet. So most banks will be somewhere between 4 and 6% of the balance sheet. So we can already see that maybe the liquidity is a little bit lower. Securities is about average for allocation to the assets. Loans, it's a little bit higher allocation. It's about 78%. Most banks might be somewhere between 70-75%, so a little bit higher allocation to loans, so that gives them a little bit more risk. But also maybe a little bit more yield as well, since securities yield probably about half of what the loans are yielding. Coming down to the liability side, they've got about $650 million of non-interest bearing deposits, and that's really low. Most banks somewhere between 19-25% of their liabilities is non-interest bearing. But these guys, this is 9%. So really low amount of non-interest bearing deposits, and so that would lead us to think that they might have some really high interest expense. This in addition to the FHLB advances being pretty high. This is about 18% of the liabilities. Most banks we might see somewhere between 6 and 9% for FHLB advances. So the advances right now somewhere between 5 and 6% on most banks' balance sheets, or yielding 5 or 6%. So that's a whole lot more than what maybe the CDs, the savings accounts, and certainly more than non-interest-bearing deposit accounts. So this leads me to believe that interest expense is probably going to be pretty high relative to most banks, just because they've got more of the liabilities or the funding sources coming from higher cost funding sources, and that's on top of the bank actually being a lot more leveraged than most banks. The assets to equity is about 15 times, 15 and a half times. So most banks would be somewhere around 10 to 11. So these guys are really a lot more leveraged. So that means they've had to bring on a lot more debt and liabilities to fund the assets here. So already we can tell that, perhaps on the liability side, the interest expense is going to be a little bit higher than most banks. But since a higher percentage is allocated to loans, maybe that's will yield a little higher interest income, which maybe puts them kind of in an average profitability. But we'll see kind of how that works whenever we get down into the income statement. Yeah, so what we have here is about 85 million of interest and dividend income, 54 million of interest expense, which gives us a net interest income of almost 32 million. So the 85 million here is about 5.06% of assets, and that's right around in the middle of the range of most banks right now. So I think that, what we were talking about earlier, their higher allocation to loans is helping them have a better net interest income here, at least with it being within the range of what we might expect. And then from the interest expense part, interest expense is about 3.24% of assets. So that is a lot higher than most banks. Most banks somewhere between 2 and 1.5% and 2%. So these guys are, perhaps double interest expense than what most banks are, and so that's produced a net interest income of 32 million, which is 1.75%, and that's really low as well. Most banks would be somewhere between like 2.8, 3.2. So these guys have about half the net interest income of what most banks might have, and that's mostly due to the liability side of their balance sheet being really allocated to a lot of more expensive funding sources. So coming down to the non-interest income, non-interest expense, non-interest income of about 17 million. That is about 17% of the revenue. So, and that's a little bit higher than most banks. Most banks somewhere between 10 and 14. So 17% is a good amount of non-interest income. They got some wealth management, mortgage banking, credit card stuff. So that's helping perhaps shore up a little bit of the money that they're not making in the net interest income part. And so then coming down to the non-interest expense, this 34 million is about 33% of the revenue, and that's really low as well. Most banks somewhere between 41 and 47%. So, even though they've got a lower the higher interest expense is making them have a lower net interest income, they do have a higher non-interest income and a lower non-interest expense. So maybe that kind of evens things out, At the end of the day, they've got about 11 million of net income. And so as a percentage of assets, that's about 0.62%, which is really low compared to most banks. Most banks' return on assets is somewhere between 0.9 and 1.1%. So, 0.62% return on assets is pretty low profitability. And I think it's mostly because of the higher cost funding sources, and even better non-interest income and cheaper non-interest expense couldn't mitigate what is happening on the liability side of their balance sheet. So we can already see the bank is not as profitable as what average bank might be. But if you were to compare this 11 million, annualized, compare it to the market cap of the company, you get about 10% earnings yield, which is kind of an average earnings yield for banks right now. So it's really kind of priced lower to compensate investors for a lower profitability. So really the price for these earnings, if we're just looking at the earnings amount, is about average for most banks. So in just looking at the profitability, the price could possibly be reasonable for the profits, but we haven't really looked too much at the risks so far. So once we dive into the risk, we'll be able to see, and the growth prospects as well. Does that price on the earnings seem reasonable or not? So, all right, so let's scroll down a little bit to the footnotes, and we'll be able to dive into some of the details. As we talked about, the bank is headquartered in Rhode Island, and the bank itself is called the Washington Trust Company. It's been in place since 1800. They say it's the oldest community bank in the nation. So that could possibly lead us to believe that, hey, if these guys have operated for over 200 years, is there a risk that they go defunct today? I guess there's always that risk, but they have operated a long time. I think that's a good, valuable quality. So going down to the securities, we see here it's mostly mortgage-backed securities. That's pretty common with most banks. They've got some GSEs here, but that's the gist of it. All of it's available for sale, so we know that they're going to be sitting on the balance sheet at fair value. So there's not going to be any adjustments or considerations for price to book ratios and such if we were to adjust to fair value, because it is at fair value. But like most banks, we see there's a pretty big unrealized loss sitting here. But of course, they don't realize that loss unless they sell the securities. So that would depend on the liquidity and all that stuff of the company. But and we can also see here the term structure. So it looks pretty even actually. So even though there's not a lot maturing in the next year, they do have a lot maturing in 1 to 5 years, and then pretty consistent over the next time periods. So, from an interest rate risk standpoint, this looks, okay. There have been a few banks I looked at recently that had, the majority of their securities in the after 10 years age, and that would be really, really risky as they're stuck in lower interest rates for a long period of time. But these guys, at least, they mature within 5 years, so maybe the interest rate risk isn't as high, at least for the securities. But the larger percentage of the assets on the balance sheet is the loans, so those end up being more of the determining factor of repricing risk on the asset side. So as most all banks right now have in this footnote, the unrealized losses are related to market prices and not necessarily credit risk. And so there's usually, most banks don't have an allowance on their securities, at least the mortgage-backed securities and obligations of the U.S. government, that type of thing. Corporate debt securities might have an allowance in some cases, but usually we don't see that very often. So usually no allowance or no write-offs for most banks, and that's the case with this one as well. But so anyway, we're down to the loans. We see that most of their loan portfolio is commercial real estate as well as residential real estate. So as a percentage basis, about 83% of the loan portfolio is real estate, and and actually a pretty large percentage relative to most banks is in the 1 to 4 family. And it's about 45% of their portfolio. So about half of their portfolio is single family homes. And that's a lot higher than most banks and comes with its own risk, in particular long fixed rate mortgages from an interest rate perspective. Typically there's not as much credit risk there as maybe commercial type loans, but so yeah, some things to consider is that they've got a lot more residential real estate loans than what most banks do, and yeah, so we might learn a little bit more about that risk coming down here. So past due loans is only about 10 million, and that's really, really low. It's about 0.18% of loans. Most banks would come across somewhere between 0.5 and 0.8%, so that's actually a really low amount that's past due. As far as the non-accrual loans, they've actually got 30.7 million of loans that aren't accruing, and that's actually a little bit higher than most banks. Most banks is somewhere between 0.3 and 0.5% of non-accrual, but these guys have got 0.54%. So, and you can see a lot of it is in the commercial real estate part, where there's loans that are not accruing. But I also have some in the residential real estate, but not as much as the commercial real estate. And they've actually kind of accrued for most of it in the residential side. But the commercial real estate side, they have not accrued for. So that could be a potential risk for us, is that maybe they haven't reserved enough for loan losses in their commercial real estate book. So we'll be able to see a little bit more about comparing the reserve to the classified loans when we get to that part down here. And they've also got a pretty high amount of collateral dependent loans, 34 million. So these are the ones that are expecting to be paid off by the collateral as opposed to by the loan itself being paid off by the customer. So it's about 0.6%. Most banks somewhere between 0.3 and 0.5. So we can already see that they've got, and it's mostly in the commercial real estate side. So the commercial real estate credit quality, I think, is below or worse than what most banks are, and they could be in a place where they haven't reserved enough for it as well. So, and we see a little bit more about that here in the classified loans. So these are ones that have a defined weakness and that might not be paid back in full. So classified commercial real estate, 41.5 million, and then 1.7 for C&I. So if we were to add all these together and include the consumer side, we would get about 54.6 million, and that represents about 0.96% of loans, and that's a little bit lower than what most banks are. The commercial real estate part in particular, about 1.93% of their loans are classified. And it's kind of on the higher end of what we might see in most banks, but I think what's kind of keeping them together on this is that they have a large percentage of their loans are residential real estate, which don't have as much of that credit quality issue. So they have a little bit lower amount of classified loans, but if we were to look at the allowance that they have, the allowance is only 41 million. So 41 million versus a 54 million amount of classified loans is a little bit lower of a ratio than what we might see for most banks. I usually like to see their allowance as a percentage of the classified loans to be at least like a 1-to-1. But In this case, they haven't accrued as much. They've accrued 32 million of commercial real estate, but you can see here that 54 million of it is classified. So I feel like they haven't reserved enough, and eventually, if the credit quality of the loans becomes more pronounced as being less likely to be collected, or the loss given default becomes more, we would see a higher reserve, which of course cuts into the net income for the company. So I would view that as a risk for the credit quality. Not only the credit quality being a little bit elevated due to the commercial real estate part, but also them not reserving enough. And so diving more into, the derivative side, I usually look at this as in the perspective from interest rate risk. So they do have some cash flow swaps where they hedge the cash flow of some of the FHLB advances. And I might have skipped over it. Yeah, so they have cash flow hedges associated with the short-term borrowings, and the notional amount here is 120 million. So you remember that they have, I think it was 1.24 billion advances outstanding from the FHLB. So they're hedging 120 million of it with these cash flow swaps. So I think that's a great policy. Especially since they have so much on the liability side that reprices quickly. They need to have some kind of hedge to prevent getting further squeezed if interest rates were to go up. So this is helping them kind of fix the interest rates on those FHLB advances, so they don't get hit with more interest expense if the rates go up. So I think that's really great for the interest rate risk. So to recap the interest rate risk, we saw that the securities reprice pretty quickly. They have these swaps here to help kind of on the liability side, at least a little bit. So once we look at the call report, we'll be able to see a little bit more of the term structure of the loans, and that'll help us make a determination on interest risk. But as is now, some of the policies I think are they're doing things well. Anyway, so diving down into the fair value footnotes, we can compare the balance of what's presented on the balance sheet compared to the actual fair values of the securities and loans and such. As we talked about, the securities are available for sale, so they're already at fair value on the balance sheet. So really the only difference from an asset perspective is the loans. And so it looks like the fair value of the loans is about 250 million less than what it's carried on the balance sheet. And that represents about 54% of equity. So, and that's a lot. So basically, if you were to convert the loans to their fair value amount, you lose 50% of the equity of the company. And so if we converted the assets and liabilities to fair value and kind of looked at the net asset from a fair value perspective, it's about 2.5, or rather the market cap of the company is about 2.5 times what the fair net asset value, excluding the goodwill and intangible. So a tangible market to fair value of net assets amount is about 2.5 times what the market price, or 2.5 times that. So for the net asset value of the company, you're paying 2.5 times. And that's a little bit outside of the normal range that we might find in the average bank. Average bank is somewhere between 1.5 and 2.5 times. even if a bank were to be acquiring another bank, they're usually paying around 2 times of the fair value of the net assets. So in this case, the net assets at a fair value is priced a little bit more expensive in the market than what the average bank is paying, or rather it's being traded for. So, looking at the borrowings, we can see here the FHLB advances, 1.24 billion, which we saw on the balance sheet. A lot of them mature within the next year, and so that means they will reprice into higher interest rates. But as we saw, they're hedging about 120 million of that. That's nowhere near all of the 600 million that's going to reprice in the next year. So that's a risk from an interest rate standpoint. The rest of it is maybe in a 1 to 5 year period, which we see on the call report as well. They've got another $1 billion that they could borrow from the FHLB, so that would be helpful from a capital standpoint. Speaking about a capital standpoint, looking at the net assets at a fair value compared to the assets at a fair value, the net assets are about 2.5% of the fair value of assets, which is really, really low. It's actually about half of what the normal bank is. So that's saying, the fair value of the equity of the bank is only 2.5% of what the fair value of the assets is. So that's really, really leveraged. And when we were talking about before, the leverage is about 15 times on the balance sheet, when most banks are leveraged about 10 times. This kind of corroborates a little of that, where the equity is only 2.5%. And so that would mean that the assets at a fair value standpoint are leveraged 40 times. So 1 divided by 2.5% is 40. So that's really, really high leverage and probably a lot of risk. So skipping through here, we can also see the capital risk from the standpoint of the regulatory ratios as well. The leverage ratio is 7.81%. That's really, really low. Most banks are somewhere between 9.5% to 10.5%. These guys are 7.81. It's not outside the range of failing any regulatory requirements or anything, but it's just really, really low. As are the other regulatory ratios as well. The 10.5%. These are all below the range of what most banks might be. So I think that part of that is the leverage from what we discussed before from the balance sheet and the fair values, but also from commercial real estate gets dinged a little bit for in these regulatory ratios from the risk weightings, which residential real estate usually gets a lower risk weighting, I think 0%, but it really didn't help them in this case. So, even though they're not violating any of the thresholds that they're supposed to for the regulatory standpoint, these ratios are a lot lower than most banks, and kind of showcases how leveraged and risky they are compared to most banks. And so we can get down into the MD and A down here. Okay. So then we can see a little bit more about the interest rates. We can see some of the statistics they've built for us as well. 0.61%. I think we calculated 0.62% for the return on assets. That's pretty low. Return on equity pretty low. And we can see that, last year they had higher ratios for this. So they've deteriorated a little bit, and it's more than likely related to the liability of their balance sheet repricing quickly. We can also see the efficiency ratio. This is essentially the efficiency ratio. Never mind, no, it's not. It's backwards. Their efficiency ratio for the first quarter was about 70%, which is really high. It's basically the non-interest expense relative to the revenue of the bank. So we would want to have a lower ratio. So the 70% is saying that their expenses aren't are a little bit higher compared to the revenues than most banks are. So it leads it's a measure of profitability. So we can see a little bit of the yields here. You see the total interest earning assets 4.93%. That's about average for most banks, somewhere between 4.75 and 5.25. So as we talked about earlier, this is coming in, their interest income's coming in at an average range. But then when we look at the liability side, we've got 3.63% yields here, which that's a lot higher than what most banks are. Most banks are somewhere between 2.2, 2.7. So that's what's really cutting into their profitability and making their net interest margin be really low. Most banks will be somewhere between 3 and 3.5% on net interest margin. These guys have about half of that. So really their liability side of their balance sheet is really eating into them, and that's because of the FHLB advances, which give a lot higher cost than other. They've also got, it looks like, a lot of brokered time deposits, which end up being a lot more expensive than their in-market time deposits. So that's also hitting them. So it's they're having to really fund their operations and their loans through higher funding sources when a lot of other banks might be funding through deposits and stuff, which are cheaper funding sources. So it's really hurting them on the profitability side, and that's evident from these ratios as well. And so skipping through all this stuff that we've already kind of discussed as part of the actual financial statements, you can look at more of the capital or liquidity type information. Okay, liquidity and capital. Yeah, so they can borrow another $1 billion. We can see here from the FHLB, borrow a little bit from the Federal Reserve. They've got $52 million of cash, which actually isn't a whole lot when you look at the size of their balance sheet. And unencumbered securities, $670 million. So that gives them about almost $1.8 billion of liquidity that they could borrow if they get into a tough spot. And that's actually pretty good. It's a little bit lower than what most banks are, but I think that's probably enough to weather any storms. Of course, if they were to borrow from any of these sources, it would hurt their net interest income, and net income at the end of the day. So as we saw, they're really, really highly leveraged compared to most banks. And, so it presents a risk that they would have to borrow some more from this, and that will be expensive funds that they have to borrow, and that will eat into more of their margins, I think. So that's the capital risk here and the liquidity risk. I don't think it's necessarily a risk of being insolvent or not being able to carry on, but it is a risk of net income going down, to get into a place where they need to borrow more money. And especially when we're talking about the credit risk as well. So I could see them needing to dive into some of these additional sources, and that'll eat into the interest income as well. So getting into more of the interest rate risk, we can see here that they do make more net interest income, or they're projected to make more net interest income if interest rates were to increase. So, these are all the increases. I feel like they've kind of got these backwards, but it is what it is. And if interest rates were to go down, their net interest income would go down. So this is sort of evidence to show that their balance sheet might be asset sensitive, which means the asset side would reprice sooner than the liability side if interest rates were to move up or down. And so, we talked about how a lot of their securities perhaps have maturities sooner than the average bank, but that also the loans might be the indicator because there's a higher balance of them on the balance sheet. So if you were to look at the call report, you would see that about 40% of the loans reprice within a year, and that's a lot higher than most banks. Most banks somewhere between 25 and 35% of their loans reprice in the first year. And so these guys are about 39-40%. So that means that from an interest rate perspective, they're more than likely the reason why that they're asset sensitive. And so within the first 5 years, according to the call report, the loan about 60% of their loans reprice within 5 years. So I think that's why that presents a lower interest rate risk, especially given our concern that they've got such a large amount of liabilities on their books that reprice sooner. Having a lot of their assets reprice sooner helps to combat that to where they don't get squeezed if interest rates were to go up. So I feel like their interest rate risk is solid. So I think that's the end of it. One of the things they didn't mention, there's a legal side here as well. They didn't mention it here, but there was a disclosure that they did enter into an agreement with the Department of Justice that for fair lending violations, I believe they're supposed to subsidize some mortgages for about $7 million, and a couple other additional dollars need to be spent on raising awareness. They've got to open another branch in Rhode Island, so they've kind of been dinged a little bit for fair lending laws, which might cost them a little bit of money in the future, but it's not that large of an amount. So $7 million out of I guess that represents almost if their net income this quarter was 10 million, that ends up being a large percentage of that. But from a loan perspective, it's not a large percentage. So anyway, so that's the gist of it. To recap things, they've got about an average profitability. Fortunately, the loans, the asset side of the balance sheet, and having additional leverage kind of helps to mitigate the more expensive funding sources on the liability side. So they end up being it's a little bit lower profitability, but the price on the bank is or the market cap and the price of the stock has decreased a bit to compensate investors for that. So the price you pay for the earnings is about average of most banks. But I think what the price doesn't compensate for is the capital risk. Or we talked about they're really, really highly leveraged currently. And also regulatory ratios are a lot lower than most banks. So if they were to need to borrow more, especially since they have a pretty low amount of cash on their balance sheet. If they had to borrow more, they would have to borrow more at these higher funding sources, and it would be even more interest expense and hurt their profitability. So I feel like for that reason alone, the price of the stock should be a little bit lower than the average bank, because that's not customary for the average bank currently. So we should probably see a lower stock price to mitigate for that risk. And so we also saw a little bit higher credit risk, especially related to the commercial real estate here. So that could be another ding to net income in the future if they would need to reserve more or write off some of the loans that haven't already been reserved for. So that's also a risk to the net income, which I feel like the stock price should be a little bit lower to compensate for as well. Fortunately, the interest rate risk comes in okay, as we talked about. A lot of the loans reprice quickly, which mitigates a lot of the quickly repricing liabilities. They also have hedged some of the short-term repricing of the FHLB loans. So I feel like the interest rate risk is solid, but the bank already not being as profitable as most banks, and then the credit risk, and then the capital risk as well, makes me feel like the stock price should be a little bit lower than what it is for someone to, or for a rational investor to want to buy this bank. So that's it. Let me know in the comments if there's anything that I missed, or any questions you have or clarifications that might be helpful. But yeah, thank you very much for listening.